Howdy, everybody. Welcome to Liberty Call. Today is Thursday, July 10th, 2025. Hope you're having a fantastical day out there in the interwebs. It looks ugly outside. It is storming and gross. It was nice this morning when I had to run out to go run an errand around noon, and sunny and clear. And then on the way back down here, stopped into Lowe's to get some P-trap and stuff for finishing up my project in the guest room here behind me, or the guest bath. And, you can hear like on those big warehouse stores when it starts raining, you could hear it. I looked up, I'm like, what is that sound? I'm like, oh, looks like I walked in at the right time, didn't get dumped on. So, and by the time I was finished, I was only in there like 10 minutes. It stopped raining again, which was nice. And I went to the grocery store and Sam's and a bunch of other places, and then finally back home. And now there's another fresh band of clouds coming over us. So anyways, markets held steady as investors weighed fresh tariff threats against NVIDIA's $4 trillion milestone. The S&P and NASDAQ edged, now they're actually higher, while the Dow stayed afloat. Delta Airlines took off on strong earnings. WK Kellogg jumped on takeover rumors, and traders' eyed Trump's latest copper and Brazil tariff volleys. With Fed minutes hinting at possible rate cuts by September. Well, that's not what I got out of it. I got that some wanted rate cuts, some don't want any rate cuts at all this year. So again, people see what they want. The tug of war between trade risk and tech hype continues. So before we break all the news down, if you could do me a favor, give me some thumbs up, a like, share, subscribe, a follow, and press the notification bell. Let's get into the markets. Dow Jones was up 0.43%, 192 points, closed at 44,650. S&P 500 up 0.27%, 17 points, closed at 6280. NASDAQ up 0.09, 12 points, closed at 2630. Let's see, the VIX was down 0.94%. It's at 1579. Canada up 0.41, Brazil down 0.54, and Mexico up 0.09. In Europe, Germany down 0.31%, the UK up 1.23%, France up 0.3%, Netherlands up 0.93%, Italy down 0.79%. I'm sorry, that was Spain. Spain down 0.79%, Italy down 0.72%, Switzerland up 0.98%, and Portugal down 0.56%. Russian exchanges back in the green today. The MOEX up 1.39%, the RTSI up 1.74%. And the overnight markets, the Nikkei in Japan was down 0.44, Australia up 0.59, New Zealand up 0.12. In China, the Shanghai up 0.48, Shenzhen Component up 0.47, China A50 up 0.61, DJ Shanghai up 0.46, Hang Seng up 0.57, and the Taiwan weighted when it closed on the 9th was up 0.74. All righty. Let's get to the market recap for today. S&P 500 climbs to fresh record as chip stocks ride ongoing AI-led demand. All right, the S&P 500 surged to a new record high on Thursday, driven by strong gains in chip stocks and ongoing enthusiasm around AI technologies. The rally was bolstered by Taiwan Semiconductor, TSMC, Semiconductor's report of a nearly 40% year-over-year increase in Q2 sales, surpassing expectations and reinforcing the bullish AI-driven outlook for the semiconductor sector. NVIDIA, which briefly reached $4 trillion in market cap earlier in the week, continued its upward momentum, while AMD, Advanced Micro Devices, rallied following a buy rating upgrade from HSBC. Despite the market optimism, geopolitical and trade tensions simmered. President Donald Trump escalated tariff threats, announcing a 50% levy on all Brazilian imports effective August 1st, citing political grievances tied to Brazilian President Jair Bolsonaro. Brazilian President Lula da Silva vowed retaliation, raising fears of a bilateral trade war. Additionally, Trump confirmed a 50% tariff on copper imports, further stoking concerns of inflationary pressure. On the economic front, initial jobless claims fell to 227,000, below the expected 236, indicating continued labor market strength. However, the Federal Reserve's June minutes suggested most policymakers are hesitant to cut rates soon, with only a few open to easing this month, citing concerns that new tariffs could reignite inflation. well, again, also the money supply going up does not help. In corporate news, WK Kellogg surged after Ferrero agreed to acquire the cereal company for $3.1 billion. McDonald's gained over 2% following a Goldman Sachs upgrade to buy. I'm loving it. Reflecting optimism for continued demand among budget-conscious consumers. I don't know if that's really a place where budget-conscious consumers eat, but hey, if you're budget-conscious, you probably go to the store and eat food at home because it's better for you because that McDonald's stuff is All right. Delta Airlines also climbed after reinstating full-year guidance, citing record June quarter revenues and resilience despite tariff uncertainty. Overall, AI momentum and solid economic data outshine trade concerns, propelling stocks higher and reinforcing investor confidence in tech and consumer resilience. All right. That's some good stuff. Well, there was somebody watching. They dropped off. Where'd you go? Hey. I mean, most of the time there's not somebody watching because it is like, only between 2 and 3 o'clock mountain time. So there's not a lot of people typically home. But anyways. All right, let's get to our next article, also from investing.com. U.S. weekly jobless claims unexpectedly slipped to 7-week low. Jobless claims or initial jobless claims in the U.S. unexpectedly fell to a 7-week low, dropping to 227,000, well below the forecast of is it 235 or 236? Yeah, the previous article said 236. This marks the 4th consecutive weekly decline, signaling a still resilient labor market despite broader signs of economic cooling. The data, which included the July 4th holiday, was influenced by seasonal factors and temporary auto sector layoffs in states like Michigan and Ohio. However, these layoffs were fewer than projected, keeping the adjusted claims number low. This trend reflects a labor market marked by low hiring and low firing. Employers are managing costs by trimming hours or slowing hiring rather than implementing large-scale layoffs. This strategy, while sustainable for now, may be nearing its limits. Fed Chair Jerome Powell has warned that any rise in layoffs could quickly raise the unemployment rate. Despite the drop in claims, broader labor market indicators suggest some softening. June's unemployment rate ticked down to 4.1, largely due to a shrinking labor force, and job growth is concentrated in a few sectors. Continuing claims rose to 1.965 million, the highest since November of 21, indicating it's taking longer for unemployed workers to find jobs. Tariff uncertainty, driven by Trump's sweeping trade moves, is also dampening business confidence and hiring. Of course, you got to get a little jab in there at Trump. You could string Trump up from a tree at this point for all I care. Simply because of his antics with, dropping bombs on, we bombed just in the last couple of months, Yemen, Iran, and we've been helping out with the Gaza strikes because, we're basically the arms dealer for the Israelis. And then the big, beautiful bill is full of pork and crap. And, doesn't do a whole lot. So outside of, freeing the J6 people and community sentences and pardoning people, he hasn't done a whole lot since, getting into office. Doge looked good starting out, but everything else since then has just been kind of a mess. All right, let's get to our next article here. This one's from Zero Hedge. FICO stock down more than 10% this week after FHFA opens door to VantageScore for mortgages. So this is some interesting information. Let's go through my summary real quick and see what they're talking about. Shares of Fair Isaac Corporation, or FICO, that's the people you use when you get your FICO score for getting a loan for like a car or a house or anything like that. The developer of widely used FICO credit score dropped sharply this week after the Federal Housing Finance Agency, FHFA, approved the use of its chief competitor, VantageScore, for mortgage underwriting. Lenders can now choose between FICO 10T and VantageScore 4.0 for loans sold to Fannie Mae and Freddie Mac, which together back nearly half of all new U.S. mortgages. Previously, only FICO scores were accepted. A dual score requirement was proposed, but dropped due to cost concerns from lenders. FHFA Director Bill Pulte said the change aims to expand credit access, particularly for renters and rural borrowers. VantageScore CEO Silvio Tavares praised the decision as, quote, long overdue, end quote. VantageScore 4.0 includes alternative data like rent and utility payments, which can benefit borrowers with limited credit history. Despite the shift, analysts say FICO's dominance, used in over 90% of mortgage lending, remains secure for now. Lenders may still favor FICO due to familiarity and risk concerns. Ironically, by avoiding a dual score mandate, FHFA may have helped preserve FICO's position. Still, competition could erode FICO's pricing power. The company now charges $4.95 per $4.95 per score pull, up from 60 cents in 2018. FICO's stock fell nearly 9% Tuesday and is down about 11% over the last 5 days. Yeah, I remember when I was in the collection and recovery business, and we were as collectors and recovery agents were advised not to pull credit scores all the time because A, it lowers the credit score of the person that you're pulling. I think it drops it like 10 points every time you pull a credit report. And B, it costs money to the banks that I worked for, Citibank and Chase and also and beyond. But those are the two major banks that I did the most work for. And sometimes you pull it and there's nothing to be there. So you do it again and then to be like, oops, it's like, well, these people should have paid their bills on time was my attitude. So anyways, all right. So that's some new intel out there for people that especially, I understand, if you don't have a long credit history, back when my wife and I bought our first house together, she had a townhome when we met and we sold that and bought a single family house as our family expanded. And I didn't have, other than I had a car loan and then I'd gotten a credit card about the time we got married. So I had like 2 lines of credit, by the time we bought a house in 1998. So together. And honestly, we've been together for, 30 years now. And I don't think I've ever had any utilities in my name. She's always handled that because she already had the history. And then we moved from Jacksonville to San Antonio, she did all the utilities, and then from San Antonio to Vegas for a year, and then from Vegas to Houston. I think gas, water, all that stuff's always. My name may be on the accounts, but we've always used her history. So, anyways, all right, I got one more article here. I'm just rambling, blah 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 blah. This comes from the Mises Institute. The CBO, the Congressional Budget Office, isn't allowed to forecast an inflationary debt crisis. I wonder why. Let's find out. And this was written by Mr. Robert P. Murphy, one of the smartest economists in the world. So we'll see what he has to say. All right. In a recent post on Infinio, economist Robert P. Murphy critiques a tweet by modern monetary theory advocates Stephanie Kelton and Warren Mosler, who claim that if the Congressional Budget Office isn't forecasting significant inflation, then rising U.S. federal debt isn't a problem. If you don't do a forecast on it, there's no issues out there. Murphy argues that this logic is misleading and ignores major issues with both the CBO's modeling and the premises of MMT itself. Kelton's core MMT argument is that the U.S. government, as a currency issuer, actually the government doesn't issue currency, the Federal Reserve does, can always afford to pay its obligations by printing money. That's called counterfeiting, folks. The only real limit, according to her, is inflation. If government spending pushes demand beyond the economy's capacity, prices rise. Where have we seen that in the last 5 years? Oh, yeah, when they increased the money supply by 40%, the M2, and, we saw everything across the board get more expensive, somewhere between 30 and 50%. Typically, whether or not it's gas, energy, groceries, your Cheerios, everything, has really gone up. Therefore, if inflation forecasts are tame, there's no danger in escalating debt. Murphy identifies 2 major flaws in this view. First, the CBO's inflation projections only cover a short period and are constrained by political neutrality. They don't model inflation spirals or debt crises because doing so would be seen as injecting ideology. Second, relying on such forecasts is risky, as both Kelton and the CBO failed to anticipate the post-COVID inflation surge. I was bitching about it at the time. I'm like, we should not be doing all this stimulus. It's going to create a boatload of inflation. We could probably go back to videos in this, if I did videos back then, in the summer of 2020 when they were doing all this stuff. And then when, Biden came into office and did another stimulus package, at the time I was like, this is terrible. This is going to lead to a lot of inflation. The summer of 22, I believe, Janet Yellen was like, oh, it's just this inflation is transitory. She always used a fancy word for temporary. And, we know what happened there. All right. He also points out that CBO projects debt to exceed 150% of GDP by mid-century, yet still assumes stable 2% inflation. Sure. An unrealistic assumption given the recent bond market reactions, including Moody's downgrade of U.S. debt. Murphy concludes that dismissing debt concerns based on short-term inflation forecasts is dangerously simplistic. He reminds readers that neither MMT proponents nor the CBO predicted the inflation spike after 2020, highlighting the uncertainty and potential risks in assuming federal debt can rise indefinitely without consequence. Yeah. I mean, again, the Keynesians who believe that, everything is just this fancy model and, well, if we just raise taxes, then we're just going to have all this more revenue because everything over here, say that the business side of things, the consumer side is just going to stay the same if you raise taxes here on the other side of the scale. So in reality, when you raise taxes, then people have less money to spend in the economy and they typically start hoarding, which then slows down the economy and causes more problems. You actually get higher tax revenues when tax rates are low because people spend more because they have more money in their pockets. And then, it has a multiplier effect. But what do I know? I'm just a financial advisor sitting in the mountains. All right. Well, that is everything that I had to babble on about for today. So if anyone needs to get in touch with me, where do you want to go? DSAFinancialGroup.com. All your financial planning needs can be addressed there. So give me a call. I'll be glad to help. All right. Well, hope everyone out there has a wonderful evening. And I'll be back tomorrow, hopefully, to tell you about what happened in the news tomorrow. Have a great night. Talk to everyone then. Bye-bye.